The US AI market is currently valued at roughly $27 trillion. That's not spending. That's not revenue. That's the number investors have agreed to believe, and belief is the only thing holding it up. For comparison, the entire .com bubble, Pets.com, Webvan, every sock puppet, and every Super Bowl ad peaked at around $6 trillion before it lost 78% of its value in under 2 years. The AI bubble is more than 4 times that size, and it's built on a foundation nobody in mainstream financial media wants to look at too closely, because looking at it closely means admitting the story is more complicated than AI good or AI bad. And if you've ever wondered what actually happens in the hours and months after a bubble this size loses its nerve, not the panicked headlines, the actual mechanical sequence, step by step, hit subscribe, because that's exactly what this channel is for. Now, back to the $27 trillion. Start with what a bubble actually is, because the word gets thrown around until it means nothing. A bubble isn't just expensive. Expensive is fine. Expensive is Apple. Expensive is a Rolex. Expensive on its own has never crashed a market. A bubble is when the price of something depends entirely on the belief that someone else will pay more for it later, regardless of what it's actually generating in cash today. Right now, the 5 largest AI exposed companies account for close to a third of the entire S&P 500. That means your index fund, the boring one your 401k defaults to because a financial advisor told you it was the safe, diversified option, is quietly a leveraged bet on AI whether you asked for it or not. You didn't choose this position, it chose you. Here's the part financial media skips because it's not dramatic enough for a headline. Bubbles don't pop because the technology is fake. The internet was real. E-commerce was real. Pets.com still went bankrupt 268 days after its IPO because the technology being real and the company being solvent are 2 completely different questions, and Wall Street has a long, ugly habit of confusing the 2. AI is the same split. The technology works. Whether the company spending $500 billion a year building it can turn that spending into profit before the money runs out, that's the actual bet. And right now, nobody has proven it either way. Not the bulls, not the bears. Nobody. So who's holding that bet? Not retail investors buying Nvidia in their Robinhood account on their lunch break, although they're in it too, usually without fully understanding what they bought. The real exposure sits with Goldman Sachs, Morgan Stanley, and JPMorgan, who between them hold a significant share of the debt financing the data center build-out. And here's the mechanism that makes this different from just stocks going down, which is the version everyone already understands and therefore the version nobody bothers explaining properly. A stock losing value is paper. It's a number on a screen that can recover next quarter. Debt losing its collateral is a phone call. When a data center gets built with borrowed money, the data center itself is the collateral sitting behind that loan, the same way your house sits behind your mortgage. If AI demand doesn't grow the way the loan assumed it would, the data center is worth less than what's owed on it, and somebody has to eat that difference. That's not a hypothetical dreamed up by bears. That's exactly what happened to overbuilt fiber optic networks after the .com crash. Companies laid thousands of miles of cable assuming infinite bandwidth demand. The demand arrived a decade late, and the debt came due right on schedule regardless of whether the customers ever showed up. You already got a preview of the mechanics, and most people missed it because it happened fast and financial media covered it like weather instead of like a warning. In January 2025, a Chinese AI lab called DeepSeek released a model that performed close to America's best systems for a fraction of the training cost. Nvidia dropped 17% in a single day. That one day wiped out roughly $600 billion in market value, more than the entire market cap of Exxon, gone before most people finished their coffee. Not because AI stopped working, because the story investors were paying a premium for that only a handful of companies could build this technology at massive cost, protected by a massive moat, took a direct hit. The price didn't move because the product changed overnight. It moved because the belief changed overnight, and belief, it turns out, is a much more fragile thing to build a $27 trillion market on than anyone wants to admit. Then it happened again, closer to home, with less of an excuse. In January 2026, Microsoft lost $440 billion in market value in a single trading day, on renewed doubts about whether AI infrastructure spending would ever generate a return proportional to its cost. $440 billion, gone before the closing bell over a spending question nobody had definitively answered either way. That's not a crash. A crash is the whole system failing at once. That's a preview screening, and the theater wasn't even full. Now stack those 2 days on top of the actual size of the bet. $27 trillion isn't sitting in a vault somewhere waiting to evaporate in one dramatic afternoon. It's distributed across pension funds, index funds, corporate balance sheets, and bank loan books, all wired together in ways most account holders never think about until the wire snaps. And this is the part that separates a bubble popping from a stock simply going down: contagion. When Cisco lost 86% of its value after the dot-com peak, it wasn't just Cisco shareholders who felt it. Cisco was the plumbing of the entire internet build-out. Routers, switches, infrastructure, the unglamorous stuff nobody puts on a magazine cover. And when its valuation collapsed, every company that had financed expansion, assuming Cisco-level demand, got dragged down with it, whether or not they had anything to do with Cisco directly. Nvidia is playing that exact role right now, except bigger. It's not just a stock people day trade, it's the collateral assumption sitting underneath $1 trillion of other companies' balance sheets, the load-bearing wall nobody checks until the ceiling starts cracking. There's also a piece of this that has nothing to do with Wall Street and everything to do with your electric bill, which financial media almost never connects to the AI story, even though it's sitting right there. Data centers run on power, enormous amounts of it, and utilities have been signing decades-long contracts to build out capacity specifically for AI demand. The same way cities once overbuilt sewer systems for population growth that never quite arrived. If AI spending slows before the power demand materializes, the cost of that overbuilt capacity doesn't just disappear. It gets spread across ratepayers, meaning the AI bubble has a mechanism for reaching into your household budget that has nothing to do with whether you own a single share of stock. So, walk through what actually happens if the $27 trillion valuation seriously corrects, not the version financial media sells you where the market crashes and then recovers like it's a weather event with a beginning and an end. First, the equity losses hit fast, concentrated in the 5 or 6 companies everyone already knows by name. That part looks like January 2025 and January 2026, just longer, deeper, and without a next day bounce. Second, and this is the part almost nobody covers because it doesn't make for a clean headline. The debt doesn't reprice instantly the way stock does. Loans on data centers get renegotiated, refinanced, or defaulted on over quarters, not days, which means a visible stock market crash and the actual economic damage happen on 2 completely different timelines. The stock chart recovers a lot faster than the debt does, and that gap is exactly where financial media stops paying attention, right when it matters most. Third, and this is the mechanism that turns a sector correction into something bigger than a sector correction, because AI exposed companies represent such a large share of the S&P 500, and because so much retirement money is passively indexed into that same S&P 500 without anyone actively choosing it, the pain doesn't stay contained to people who consciously chose to bet on AI. It spreads to everyone holding an index fund, including people who've never typed a prompt into anything in their life. People who think AI is something that happens to other people's money. If this is the kind of thing you want more of, market mechanics that never make it past the headline, explained with the actual numbers attached instead of vibes. The Sketchbook Finance newsletter covers exactly this every week with more room to go deep than a 10-minute video allows. The link is in the description below and it's free. There's one more piece nobody wants to say out loud because it doesn't fit either the bull case or the bear case cleanly, and clean narratives are what get clicks. The dot-com crash didn't kill the internet. It killed the companies that borrowed against a story instead of a balance sheet, and the infrastructure they overbuilt got bought for pennies on the dollar and used by the next generation of companies that actually knew what to do with it. Amazon survived a stock price drop of over 90% and came out the other side. Google was founded during the crash, not before it. The technology was never the bubble. The financing always was, which means the real question sitting underneath $27 trillion isn't whether AI is fake. It clearly isn't. The question is, which of those dollars were bet on cash flow already in hand, and which were bet on a story that still needs one more year, one more model release, one more earnings call to prove itself before the bill comes due. Right now, nobody outside of a handful of finance departments actually knows that split with any precision, and that's not an accident. It's the same fog that sat over the internet build-out in 1999, and the same fog that always settles over a market right before someone finally asks the question loudly enough for everyone else to hear it. History doesn't say the technology fails, it says the financing gets tested, the companies without real cash flow get exposed first, and the ones left standing afterward end up owning the future for a fraction of what it cost to build. That's not a prediction about when this happens. It's a pattern about what happens once it does. And the $27 trillion question is simply who's still standing when the fog clears.